Hi everyone. Previously recorded a video on the public comparables method, or also known as the market comparables method. Some people have voiced concern that it wasn't very clear, so this little segment is just to clear up some little bit of misunderstandings. We're going to give an analogy to a non-finance topic, so that way pretty much anyone even without knowledge in finance will understand it. So, say for example, you're looking at uh, a heater. It generates 10 units of heat, okay? So say you have heater 1. This is the heat units, and this is the price, okay? So it generates 10 units of heat, and you're willing to pay, say, $5 for it, okay? So you're willing to pay 50 cents for every unit of heat. So when we look at this, the heat per dollar is 2. Or the dollar per heat is 0.5, okay? That makes sense so far, right? All you have to do is divide it like there. And then heater 2, let's say it produces 100 units of heat. It's 10 times bigger. And say you have like limitless capital, you just want to care about the units of heat. So you assume these same ratios of $2, 2 heats per dollar, or 50 cents per heat unit. How much would you pay for this second heater? It produces 10 times more heat. So intuitively, you think you want to pay $50 for it, right? Because if it produces 10 times heat, you pay 10 times the price. That's the beauty of multiples. The reason why we use multiples, which essentially are just ratios in the public comparables method, is that some companies are different. Say you have in our prior example of laptop manufacturing, if a company makes, say for example, 10 laptops, and another company makes 100 laptops, and you have a value for the first company, but not for the second company, you can't just use the same price, but you can use the same price multiple. So same thing for, in this case, for heater 1, you have a price of 5. For heater 2, you don't just use the 5. You use the multiple with the difference in size, and you get 50. So that's why in our prior example, when we talked about the price to earnings ratio method and the EV or EBITDA, we'll talk about price to earnings first. So you have that laptop manufacturer 1 and laptop manufacturer 2. Say it has sales and earnings. Earnings being something that's seen as like profit, for example. And then we have like an overall price. So for sales, say this company manufactures 1,000 laptops, and it earns 100 units of profit, and the company price is 500. Okay, so for company 2, if its company's half as big, so it has 500 units of sales, and correspondingly has $50 of earnings. How much would you pay for the second company? It's half as big, it earns only half as much. You would pay $250. Does that make sense so far? And then, so therefore, essentially it's looking at one company. If you only pay $5 for a company, the company that's half the size, you will pay half the price for based on its earnings. But when we look at this, when we look at the PE ratio, you'll be interested to note that this is a PE ratio of 5. This is also a PE ratio of 5. Same thing for company, a third company, L3. If it's double the size and double the earnings, then you would expect to pay double the price. And how do you get this price? By something that using the same price to earnings ratio, right? Now, what we did here was we looked at one company and we assumed that the other companies follow that one company's example. But in the real world, you have a company that you're trying to value, and you have 5 or 6 companies that are comparable, and you want to use an average of those other companies. So let's do a more realistic example. So we have 4 companies. Let's say 10, 15, 20, and 5. Okay? So the earnings are that. And then the price, let's just say it's around double. This is around 35. This is, say, 35 again. And this is 7. Now, when we take a calculator and actually calculate this, the price to earnings ratio here is 2. For that other one, it's 2.3. And then that other one is 1.75. And then 1.4. Now, when we look at this, let's think about what the average is, okay? So the average, the mean, which is what's people known as the simple average, is just .871, okay? The median would just be looking at the average of the 2 middle figures. So it would be 1.75 and 2, so 3.75 by 2, 1.875. Sometimes if you feel this one is too low, that's why you have to pick the right comparable. Some people might exclude outliers because they might be seen as companies that aren't very comparable because, for example, company 4 might be in a special situation. Now, we have then the company we're actually trying to value. Let's say they have $23 in earnings. We take the $23 earnings, you multiply that by the P ratio that we select, say 1.871. And then we come up with a price of 43.033. So essentially what we did here was we looked at the publicly traded companies 1, 2, 3, and 4 for laptop manufacturers, and the reason why we call this public comparables is because we looked at publicly traded companies. So we have how much they earn and what the current stock price is. We took the average of these 4 companies, the P ratios, coming up with an average of 1.871, and then multiply that 1.871 with the earnings of the company that we're trying to value of 23. The company we're trying to value, we know its earnings, but we don't know its price. It's not publicly traded. Say, for example, it's a private company that some guy owns. There's no stock price to it, so you don't know how much it's valued at. But the market valuations are there. So by using that ratio that we derive from its comparable companies, because these are all laptop manufacturers. So say if you have a chair manufacturing company, you want to compare it to other chair manufacturing companies. We come up with a value of a price of 43.033. And intuitively, it kind of makes sense because when we look at it earns the most of all the companies, so therefore it has the highest price. And this one's valued a little bit low, and this one's valued a little bit high, but then on an average, it matches. So whether you use the mean, the median, or whatever other metric, the mechanics behind this method stay the same. Look at other companies, you look at these ratios, and then you multiply in the target company's inputs, and then you have your target company's valuation. Hope that answers all your questions, and if not, we might even do a part 3 of the series. Thank you, and please watch our other videos. Click subscribe because We want more subscribers. And then after you subscribe, share to your friends. Thank you.